Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and I have in the office studio another special guest, Kyle Scholl. Kyle, welcome to the program.
How's it going?
It's going fantastic. Kyle has his own YouTube channel, and the name of that YouTube channel is
Financial Awareness with Kyle Scholl.
And that is K-S-C-H-O-L-L.
That's impressive. You got that. Good job.
Yes, look at that. And you guys who tune in often, you've heard me say over and over again that I'm not a financial advisor, but I play one on TV. Well, Kyle Scholl here, he is one step above even that because he's not a financial advisor, but he once was one. He spent 7 years of his professional career as a financial advisor. You spent another 7 years as a professional real estate agent. Is that correct?
Yeah, so just quick background, if
Yes.
that's okay.
Yeah, go for it.
So very intentional with my degree. You know, you'll often hear people say, oh, I don't know what I want to major in college, or, oh, I went to college and I got this degree. Well, I wanted to actually apply my degree. So I spent a lot of time talking with my guidance counselors in my undergraduate studies. So I ultimately decided on finance and real estate as my double major. Finance was my main major. And then I was like, gosh, you know, I'm going to buy a home one day.
Yeah,
so
exactly.
Might as well take some real estate classes as my electives. So that became a passion of mine. I really enjoyed learning more about real estate. And then that turned into me meeting with my guidance counselor. And she said, you know, you're only like 6 credits away from a double major. So I said, well, shoot, that's fantastic. I'd love to do that. So I kind of stacked myself my senior year a little heavy, but ultimately ended up double majoring in finance and real estate. And I was going to work with Merrill Lynch. I was going to work with CB Richard Ellis. I had internships with both, but fell in love with residential real estate. So,
no way.
Yeah. So right after college, ended up spending 7 years working for a home builder locally here in Central Florida. And that was great. Really enjoyed it. And then just made some really good financial decisions in my 20s, which we can discuss a few of those today based on what we may or may not chit-chat about. But yeah, just kind of got myself in a good spot and then decided to leave working weekends, which a lot of realtors do, a lot of people in real estate do, to become a financial advisor. And I did that for about 8 years.
Wow. And then now you would consider yourself a
financial coach.
Financial coach. Perfect. And the point of the I call it a podcast. It's not a podcast. This is a podcast.
Yes.
You have a YouTube channel.
I do.
And the point and the purpose of the YouTube channel, you're sharing with me off camera.
Yep.
But I loved the answer, so I'm going to ask you to repeat it to me
Sure.
so that it can be shared with the audience.
Yep.
Is because, as you explained it, you wanted to widen your net for the people that you could help.
Yeah.
Tell me more about that.
Yeah, I as I've gotten to know your show and your podcast a little bit, I think we have a lot in common. As a financial advisor, you're limited with who you can help. I really appreciate the kneecap to kneecap conversations, the eyeball to eyeball with your clients, and that's very personal and wonderful. But having a YouTube channel and having the ability to scale that and to have a message that resonates with some people, and it's just good, healthy, I'll call it financial health, right?
Okay.
Good, healthy financial knowledge, good, healthy stuff there. You can touch more people. You can help more people. So I think, if you're shooting for around maybe 700 to 800 in-person meetings as an advisor, if you got a channel that has a good message, right, that resonates with people, you could help more people. So that's the kind of the genesis of where the channel began, is wanting to just share really good knowledge with more people.
Yeah, no, it's very altruistic of you because I understand from my friends who are financial advisors, there's certain criteria that people have to have just to sit down and become a client of a financial advisor. I actually have a funny story. I was in Park City, Utah on a ski vacation with my family, and I'm riding up the ski lift, and the lady next to me says, oh, what do you do for a living? And it's, for whatever reason, I always have a different answer, right? I mean, I'm in mortgage banking. I help people achieve the dream of home ownership. I'm a mortgage monkey, like literally 1,000 different things. That day I said, I am in residential finance. Okay, residential finance, which is what I am in. She heard I'm a financial advisor. And this lady started not going off on me, but going off on the fact that there's no one out there willing to get her in a position where a financial advisor would even take her on. So then when you were sharing with me the mission behind your YouTube channel and how you want to expand your reach, I thought of that lady who, by the way, was a traveling nurse, who is also from Florida. Rare and random that we were sharing a ski lift, but she needs you. Like, she needs to watch your YouTube channel because she was frustrated that no financial advisor would sit down with her because she probably didn't have some of the most basic financial fitness concepts in play or down pat. So that's awesome that you are taking your career to yet the next level, because you obviously went into real estate, such as your major dictated, and you dominated. Then you went into personal finance and did a really good job. So here you are at 37 years old, already taking your career to a third level, and I'm assuming you're going to dominate this level as well.
Thank you.
When you and I were introduced, first thing I did is I went to the YouTube channel and I just started clicking and watching, and I got stuck there for like 45 minutes. Ended up having to call home. Hey, honey, I'm going to be late. Oh yeah, rough day at work. No, I got stuck on Kyle Scholl's YouTube channel. So let me ask you this, because this is like a common theme of this podcast.
Yes.
Is everything you should have learned in high school, but didn't.
Yep.
Usually because it wasn't taught.
Yep.
When you look back at yourself as either a 17, 18-year-old graduating from, out of curiosity, what high school?
So Tampa. I went to Plant High School.
Okay,
Tampa.
Plant High School in Tampa, Florida. Heading off to Tallahassee to go to Florida State.
Yep.
What are some things, if you could go back in time and talk to that aged Kyle, that you would want him to know, especially as it pertains to things like personal finance?
That's a great question. I will answer that, but I want to. You mentioned this a second ago, and we haven't talked about it yet. But the people that put you and I in touch.
Yes.
Mike
Sue with Northwestern Mutual. Yes.
And Patrick
Shishayan with, of all companies, Waterstone Mortgage.
Yeah, and I've been a double client of Waterstone. I love your company. Have had great experiences with Patrick. If he's a reflection of the rest of the team here, you guys are doing some good stuff.
Well,
for sure.
I appreciate that, and Patrick is. He is our flagship in so many instances, because he is someone that we actually brought in from another industry and taught him the mortgage profession.
I didn't know that.
And he's also, begrudgingly to others, someone that we sometimes hold up as like the litmus. And it's like, well, if Patrick can do this, you should be able to do it too. And there's some other loan originators that are like, oh my God, can you quit comparing us to Patrick? But Mike Sue, I met Mike Sue 15, 16 years ago. We were both fresh-faced, right out of college, starting our careers. And I look back now and it's like, well, I have my kids' college savings with Mike, and I have my life insurance with Mike, and I have an IRA with Mike. And Mike has been a friend, but he's also been an advisor of mine. And it was funny because I got from Mike, hey, I'm listening to your podcast. I was actually trying to get Mike on the podcast. And without getting into too much, there's a lot of red tape when you work for huge national corporations.
Yeah.
So the long story short is it probably wasn't going to work out. And if it was going to work out, it was going to be very linear. He's like, but I have a guy that you need to have on the show. And then about a week later, I get a text from Patrick. Hey, I just listened to your most recent episode. You know who would be awesome? And I'm like, why are two people telling me that this guy, Kyle, is someone that needs to come into the studio and we need to rap? So it is a pleasure to have you. And I'm so fortunate for the connection. And what a small world, right?
Yeah.
What a small world. That
Mike's a good dude. He's a straight shooter.
Yeah,
he's a good dude.
Fantastic guy.
Yeah.
So,
Right,
but anyhow, 17 or even heck, the 22-year-old version of you.
Yeah, for sure. So, Mike, like most sons with their fathers, there's a little bit of relationship blessings or relationship judgment or whatnot. And my dad has made some interesting decisions as an adult, but I feel like he did a really good job with his kids. I'm one of 4 boys. My dad had 4 kids.
Okay.
Kept trying for a daughter and ended up with 4 boys.
So this means your mom had the luxury of raising 4 boys.
She did.
Wow,
yeah. And,
what a saint.
And she's a great, great woman. What I will say is he did not raise us to be gosh, I don't know how to say this politely. He raised us to be business minded a
Okay.
little bit, right? So, when I was in middle school, you asked about the 17, 18-year-old version of me. I had a checking account in the 7th grade. I got my first job pretty early, 12, 13.
Was that because you wanted to, or because it was being encouraged in your household to go get a job?
A little bit of both.
Okay.
A little bit of both. Because I'm the second oldest, I saw my older brother have money.
Okay.
And that was inspiring to know that you can work for something. When we were like 10, we mowed yards, right? And just got paid cash, nothing formal, but we used the money from the lawn mowing gig to buy a little Honda 50cc little motorbike guy. And that thing was a blast. So I would say that was my first experience of work hard, do something fun with the money.
And yeah, I'm going to stop you there just because it's like a ding, ding, ding type moment
Yeah.
for anyone listening who is a parent,
Yeah.
or anyone who listening who is anticipating starting a family. You would recommend at an early age having these types of conversations with your children.
Absolutely.
Encouraging them to understand finance, to open a checking account, to use a debit card, so that it's not foreign when they are 18 or when they are 22.
100%. And
Okay.
every family dynamic is different, right? So there's some kids that demonstrate a willingness or a desire earlier than some. So if you're scratching your head listening to this right now, wondering, well, gosh, I don't know if it's the right time for my kid or not, you'll know. There will be little signs. You just have to know to listen or to look for them. Now, you can encourage it a little bit by saying, hey, come over here. I want you to come look at, now, it's what it is, 2020?
Yes.
Now it's, hey, come look at the computer screen. I'm going to pay some bills.
Yeah.
A long time ago, it was, hey, I'm going to whip out the checkbook, or I'm going to whip out, XYZ piece of paper, and I want to show you how we manage the money. I would say whenever your child is expressing an interest, or, hey, dad, hey, mom, what are you doing? Don't just shoo them away. That's an opportunity. And say, gosh, let me show you what I'm doing. Even if it's something as simple as, this is how much I budgeted for the utility bill, $190 or whatever it might be, and it's, 201. It's simple math. A third grader or second grader knows addition and subtraction. Just simple math is perfectly fine. And whenever they start to express some interest, that's your foot in the door. And then from there, it just grows, right?
So for you, it's not even so much what you wish you were taught, but it's what you're grateful that you were exposed to at an early age. Because as a father of two yourself, and as a career professional, you can look back at your childhood and your upbringing and be fortunate or at least acknowledge that you may have had a step up on your peers, on your buddies that you played sports with or went to school with.
Well, everyone's got strengths, right?
Yes.
And I would say in high school, a weakness that I would say I had looking back was I wish I did have a more social group of friends. In high school, I worked like 3 jobs. So I didn't really join like our varsity soccer team until a junior. I was, I don't know, I was working.
Yeah.
I was busy working. But to get back to the original question,
Yeah.
which was 17, 18, your old self, what would you wish you would have done? I was encouraged to get a credit card at age 18. It was $1,000 limit, so nothing too, well, gosh, I don't know how many years ago that was, right? 19, 20 years ago?
Yeah.
But it was a $1,000 limit. That was my credit card for a very long time. And I was very cautious, and I didn't even get that until I had a very regular paying job. My dad co-signed my first car purchase with me, so that was helpful to help me establish credit, getting the credit card that I got as well, small $1,000 limit. But I got my credit established early. So I would say if you didn't get your credit started early, then when you're 22, 23, 25, or maybe older, trying to buy your first home, you may or may not get the most ideal rate if you don't have a good enough credit score or good enough credit history. So I would say for one thing to do in terms of either, common mistakes or just what to do 17, 18 is just start to manage your money well so that you can establish your credit and treat your credit appropriately. Money is like a hammer and a nail. It's a tool, and you can use it to your advantage, but the difficult part of money being a tool is it involves emotion. You get excited, you want to buy stuff, you want to do stuff with the money. As long as you can keep your emotions in check, in control, money can really be a great tool for you, both from a credit perspective and from a how can it grow perspective. But in addition to credit, though, I want to go to number 2, which is I'm giving my dad some praise here, but what I wish he would have encouraged more is home ownership at a younger age. I got my first home, I think, when I was 24.
That's young.
Yeah, I wish I would have gone even younger than that, though, because the day I moved in, I had 2 roommates move in. And what my dad really preached a lot was live alone for a year before you get engaged or start a family, like be on your own, like really get to know yourself a little bit. I just wish he would have encouraged more house hacking. And I think that might tie into mortgage, water zone, our show today, because house hacking for a young 22, 23, 24-year-old could be a great way to build wealth.
And when you say house hacking, I think of a childhood friend of mine, Brian, who I believe he was 19, working at Publix full-time while going to college part-time, bought a 3-bedroom, 2-bath house and rented out the 2 bedrooms to his 2 buddies. His 2 buddies literally covered his mortgage with what he charged them in rent. All 3 of them split utilities. So the extra money that Brian would have been spending on rent, he applied towards his mortgage, and by age 20, I want to say 7, he had that house paid off.
Wow.
Had the house paid off, had his buddies kicked out, and his fiance, now bride, moving in at 27, 28. That, to me, when you say hack or house hack, is that kind of what you're alluding to or pointing towards, or is that even something further from that?
What's this guy's name?
Brian.
Brian is a smart man. That's exactly what I mean. I believe you can purchase up to a quadplex, and you still get primary residential home interest rate.
You do.
Is that correct?
Yep, you 100% do.
So that would be the extreme, right? I was thinking just a home or a townhome in my example, but you could buy a quadplex.
You could, and you could live in a quad. It's 4 units, so 1 unit, and they're usually a quadruplex. It's usually 2 bedroom, 1 bath. So you would have a 2 bedroom, 1 bath to yourself. Then you'd have the other 3 units all rented out. The rent should cover the bulk of the entire mortgage payment. Therefore, you get to live for free. Now you are a landlord of 3 people, but there are 3 people who live in your building. By the way, you own the building. Mm-hmm. The only knock on that I would ever see as like, maybe you wouldn't want to do that. From my experience, would just be if someone isn't rooted, right? If someone's in a profession where they're like, I don't know if I'm going to stay in Atlanta for the next 3 or 5 years, or I don't really know if I like Austin, Texas, but I went to college here and I got my first job here, but maybe I'm originally from Tennessee and I have a feeling I may want to get back. But if someone can answer the question, yes, for the next 3 to 5 years, I'm pretty confident this is where I'm going to be. And then can you handle the maintenance? Like a quadruplex is going to be a lot more to fix that roof when it leaks. So I think someone just has to be responsible enough. But those that do it, they get light years. I guess not leap years, but light years ahead of their peers who maybe don't.
I love how you balanced that topic out, because for people that don't think that deeply into it, you hit the nail on the head. That was great, because you're right. With every financial decision, there's pros and cons, and you did a great job there of outlining some of the cons. But like we said, that would be on the extreme side, right? A townhome, a 3-bedroom townhome, a 2-bedroom townhome, rent out the other before you have a ring on your finger, before you get tied down. So sarcastically speaking, I've been house hacking for over 12 years, 13 years, because right after, I kicked out my 2 roommates when my wife moved in.
Okay.
And even though we were not legally married yet at the time, she helped out with the bills. So technically, I've never really had to cover a mortgage payment alone.
Oh, you've always had dual income, one way or the other, whether it's roommates or whether it's with a spouse or a fiance.
But to go back to the question, I wish I would have done that longer before getting married. I wish I would have had a house or 2 before getting married.
Like you're saying, your sophomore year in Tallahassee, you wish you would have purchased a property, lived in that for your junior, senior year, rented it out, and then when you moved either back to Tampa or to Orlando, purchased a home there, which you could have rinsed and repeated what you did in Tallahassee at age 20, now in Orlando or Tampa at age 23.
With enough work ethic and with enough income earned during college, yes, that's certainly possible. In my mind, I was just thinking post-college,
Okay.
right? You work hard, you make money, you live below your means, get yourself started with a good, small, easy to manage real estate property that's, like you said, if you're rooted, if you're not going to jump from city to city and you're not going to be too far away from the property, because you brought up a good point earlier, then I think it's a great way to start your wealth building, because then you really learn what it's like to be an investor. You learn what it's like to manage money. You learn what it's like to have a profit and loss statement. You learn what it's like to budget for property expenses, like you said, maintenance. So it's just a really good learning curve. Now, are there downsides? Absolutely, for sure. But I would say that would be one thing that I wish I would have done more of. What I did do really well of was pay off debt.
Yeah.
Worked hard right out of college and just saved cash and paid off debt. That was really important to me. That's one thing I did a good job of.
So how about this? More of leaning on your previous 7 years when you were a financial advisor.
Sure, yeah.
And thinking forward with your YouTube channel and the people that you want to reach and touch and change, what are 3 to 4 common, I'm going to call them mistakes, but common blunders that you see the average person making when it comes to their financial well-being, or a term I like to use is financial fitness?
Sure.
And more importantly, how should they overcome those blunders or those mistakes, or maybe change their behavior?
Change is an interesting word because people won't usually change until they feel motivated to change. So I would say sometimes people have to hit rock bottom financially. Sometimes people have to make a very big financial mistake in order for them to really realize, oh gosh, I did that wrong.
And by the way, that's not a bad thing. Like, I think that's too many times people are so afraid to make the mistake, but you should almost cheer on mistakes if you are confident you're going to learn from them. If you're right, if you're confident that, hey, I'll do it once, but I won't do it twice, then I think more people should maybe put their heads down and run really fast and run really hard, knowing that they can get back up and become better because of it.
I completely agree.
Yeah.
You took the words right out of my mouth. Learn from your mistakes. And again, talking about my dad, parents, that's one of the things he really encouraged all of us to do. Learn from your older brother's mistakes. Learn from your friend's mistakes. Making mistakes is not bad. People sometimes say, oh gosh, I made a mistake.
No, it's human.
Yeah, it's being normal.
Yes.
What's not healthy is not learning from those mistakes, right? So to answer your question from a second ago, I'd say the biggest mistake that people make when it comes to their personal finances is not caring. Just not caring. I spoke with a gentleman the other day. He's 41, 42 years old.
Young.
Yeah, young.
Young.
Yeah, he's young. Somewhere around $175,000 in retirement between a couple accounts.
I would say he's ahead of most people.
It depends on what your goals are.
Well,
right?
I didn't say he was where he needs to be.
Sure, yeah.
I just said he's ahead of most people.
Yeah. So it's funny you say that, though, because ahead of most people still didn't care. Didn't really express a huge interest in what his positions were, what his cost basis was, what his expenses were, how much fees he was paying. Just didn't care. $175,000, it's his largest asset. He doesn't own real estate. He's got a good, healthy amount of cash, wants to buy property at some point, but just didn't care. So I would say whether you're 22 or 42, doesn't matter how old you are, you got to care.
Yeah.
You got to care. You got to want to do your budget, which it's kind of like going to the dentist. I don't like flossing my teeth. I really don't. But I do because I know it's good for me.
So do I, the day before I go to the dentist. That counts, right?
That absolutely counts.
Yeah, I'm actually going on Wednesday. So the shout out to Carrie and Dr. Curley. Just so you know, when you're listening to this on Monday and I'm coming in on Wednesday, I'm going to floss on Tuesday, I promise.
I love that.
All right.
I love that. But yeah, I would say not caring. And then that can go down a whole nother rabbit hole there, which is not knowing your budget, right? You talk about my 8 years experience as an advisor. Here's another story. Really nice person, married. When I met her, she had a very young newborn, doctor, locally here in town, making around $350 a year, right?
Okay.
$350,000, great income.
Own practice or works for someone else?
Without mentioning
Yeah. Yeah,
the employer, she worked for a large local hospital.
Okay.
Yep. And really good person, honestly. Like, I was sitting at her kitchen table, it's just a sweetheart of a person to talk to. But, you know, to people listening to this right now, you hear, gosh, $350,000, that is I wish I had that income,
Yeah.
right? Again, it goes back to caring. You know, simple, basic financial questions. She had no idea how much money she made net after taxes per paycheck. She had no idea what her expenses were on any average month. Doesn't matter if it's December or if it's February. Just no clue, right? Just not caring. So people sometimes often feel like the more money you make, the better your life will be. That's not always the case. And furthermore, I have seen the more money you make, whether it be me and my wife and our family specifically, or anyone that I met that were my clients, the more money you tend to spend.
Yes.
That just sometimes happens, whether it be higher, better quality of life or other things. So not understanding your ins and outs, how much money comes in, how much money goes out, and what can I do with the difference. Literally, financial planning could be extremely complex with trusts and LLCs and S corps and write-offs and taxes. It can be very complex, but it also can be very simple.
Yeah, simple, like third grade math simple.
Mm-hmm.
X comes in, Y goes out.
Mm-hmm.
The delta is what you save.
Yep. So to go back, I really loved your story earlier about the nurse on the ski lift, right?
Yeah.
Let's talk about her, because the reason a lot of times in my previous life, when I would be introduced to somebody, they would sometimes feel like, oh, I'm not ready for a financial advisor. I'm not there. There's a large chunk of people in our country that need financial literacy, that need financial advice, but don't get called on by an advisor because there's no reason, there's no monetary reason.
Well, correct. The advisor, doesn't see a way for them to bring assets into management, and advisors typically get paid one way or the other on products or on assets under management.
Yep.
And to your point, this stuff isn't taught. Like it's not taught in high school, in college. It's not taught at the most basic level, where my soapbox, and I won't get on it for long, is it should be. It should be taught. The reason why we do this podcast twice a week, every week, is so that we can talk about the most simplistic topics that I feel like should be talked about openly.
Why isn't it?
I think it's one of those things where people don't know what they don't know, and they're embarrassed that they don't know because they feel like they should know. So they just ignore it. It would be like me having a big red spot on my nose. And because I'm afraid it's cancer, I'm not going to go to the doctor. That doesn't mean it's not cancer. No, that cancer is growing. Me going to the doctor doesn't change anything except for it makes me one step closer to being cancer-free and healthy. But I think people view their finances that way. Why don't certain people want to get on the scale? It doesn't change the fact that they're 300 pounds. It's just another way for them to avoid acknowledging they're 300 pounds. And I really think it's a systemic issue that probably goes back decades and decades, if not centuries, because you just don't talk about that, like politics or religion or her. You know, as many people that are on social media wanting to do political commentary and wanting to talk about, their opinions on social matters, I wish they all would stop and start talking about their fiscal lives. I think that would actually be more beneficial for our society as a whole than certain posts. But yeah, that would be my take on it. That's my guess. That is my guess based on looking around my surroundings and the people that I know, and summarizing it into just what I said. They're just...
Yeah. I'm going to take a stab at it too.
Okay, go for it.
So literally just today, prior to coming in, I published my most recent video. And before I make a video, I'm coming from 15 years of personal financial advice, whether it be real estate or an actual formal financial advisor type of career path. 15 years, people have been inviting me into their home to talk about real estate or to talk about whether it's investments, college planning, retirement, insurance, whatever. You learn a lot. But I still research. right? So the video I just published was based on a Bloomberg personal finance article that just came out a few days ago about how 401ks are not as tax generous as they used to be in the 80s. In the 80s, 1980, the equivalent of the 12% tax rate right now, it was 43%. So imagine being in the 80s, making the average income in America and being able to take a small portion of that, 5% of your salary, 10% of your salary, and avoid paying 43%. That's a big deal.
Are you saying the current 12% tax bracket in the 80s?
Yeah. So
because 12% is one of the lowest brackets.
Yeah.
That's low to moderate income.
Yeah. So census.gov, as of the end of 2018, the average household income for a family in America was $61,900.
Okay.
So that's where that stat's coming from. You're not in the 22% tax bracket now, I don't think, until you make over $80,000 married filing jointly, I believe. I might be a little bit off on that. So currently $62,000, yeah, you're in the 12% tax bracket. So the point that I'm trying to drill home is not about the taxes. That's not the point I want to make. The point I want to make, sorry about that. The point I want to make is I researched this video. That's the point I want to make.
Okay.
And I found out, and I didn't know this because I was born in the 80s, right? But there was some legislation that was passed in 78 and it didn't kick in until 1980. So really up until 1980, people were getting pensions. People didn't really have to think about their retirement. Now, from 1980 and beyond, people have had to take a personal responsibility for their retirement, and that's the shift. So I think for the last 40 years, people have had to learn more and more and more about how to save for retirement.
So it wasn't taught 50s or 60s or 70s.
Because it really wasn't needed to.
It wasn't needed to.
Right.
And more importantly, now that you say that, you know what also wasn't readily available in the 50s and the 60s and the 70s? Credit. Plastic. In fact, my parents used to call it plastic. Oh, honey, did you bring the plastic? What does that mean? Oh, the American Express, the MasterCard.
That's so funny.
Right? You didn't have access to, for the most part, quote unquote, free money.
Yeah. And you know what else wasn't, I love the term readily available. You know what else wasn't readily available? Information.
Yeah.
The internet.
Yeah.
Right? Technology, handheld devices, computers. All of this has made this search for the average person of how to better themselves financially has made it easier. But it's a process, right? I think, we're 40 years into the 401k basically, and it's a process. People are learning more and more about it, and it's a great tool for people to save. But why is it a great tool? Because it's easy. It's tied to the employer's. It's an employer-sponsored plan, so it's tied to your paycheck. So we were talking earlier about Credit Christie, right? About the psychology of money, the psychology of credit. Well, there's a psychology in not really ever seeing this money. And again, to go back to the analogy and the gentleman I mentioned earlier, who's 41, 42, emotionally, he did invest this money. Yes, that's true. But it didn't hit his checking account. Then he had to proactively decide to invest it. It was a 401k. He just selected 5 or 10%. He never saw it.
Set it and forget it.
Exactly. So to kind of tie a bow on this a little bit, common mistakes, right? We talked about not caring. Another common mistake is not setting it and forgetting it, right? I don't know if I said that right, but setting it and forgetting it helps make it easier. And if you can make something easier, you've got a higher likelihood of hitting your goal.
So almost in order, you want to be able to set it and forget it, but you also want to care. Don't just set it and forget it and think you're done. Set it and forget it means, and by the way, when I say set it and forget it, get with your employer, sign up for the 401k. We've talked about this with Rob Faragher on the show. We've talked about it in other episodes. We're talking about it again today, so you know it's important. It's the third time we're talking about it. You know it's important, but go ahead and schedule yourself to have X amount of dollars or X percentage of your pay going to a 401k. Usually, whatever your employer is going to match, at least put that much in, because then you get your employer's free money. So now that's set. It comes out before your money even hits your checking account, but also care. Also, every year or twice a year, go back and make sure those funds are properly allocated. And if you can't do that, maybe you need to reach out to someone who is an expert in that field, maybe your financial advisor who would look at it for you, or maybe someone within the plan administration that would do that with you as well. But your 401k would be step one of a total plan that you would put together for your overall financial fitness. I mean, a budget is one, IRAs and 529s or Florida prepaid, or if you're in another state not called Florida, then whatever your state college Florida prepaid plan is, you need 6 months reserves, you need intermediate funds, you need some real estate holdings. Like there's a whole plan that a financial advisor could sit with you to do. But I think it all starts with caring.
Yeah.
Just like you said, it starts with caring. Your biggest mistake is not caring.
Yep. I agree. And then the other thing too, to go back to either the nurse example or the gentleman I brought up, having a plan, right? You and I just casually mentioned pay off debt, just casually mentioned build up 6 months. You know, it's hard for a lot of people. Yeah, and a lot of times in life, doing what's hard is the right thing to do. And doing the easy thing is sometimes not always.
I would go as far as saying almost always.
Oh, well.
Almost always. And by the way, another book plug, I do this like almost every other episode. Atomic Habits. Have you read it?
Oh, I've read it. It's
Atomic
good. 1%.
Habits. Yes. 1%. If you change 1%, if you get 1% better every day, after the end of the year, it's something crazy like you are 37 times more optimized than you were prior to when you started your plan of becoming 1% better per day. But no, Atomic Habits, because it's what you just said. It's not about, just do a budget, just get out of consumer debt, just have 6 months reserves. It's like, no. You need to create habits that will allow you to do so. And if you need a phenomenal book on creating habits that is A, easy to read, B, easy to understand, and C, pretty entertaining, Atomic Habits. Look it up on Amazon. Go buy it. It'll be the best $25 or $27 you spent all year.
Worth it.
Worth it. I don't know how I got down that rabbit hole, but I find I'm constantly plugging books, and Atomic Habits is one I'm reading right now. I promise you guys, I do read some dogs of books, and I don't mention them. But this is one that I do feel like more people should read than not read.
So in preparing my channel, I have like a little space where I do it in, and I'm pretty sure that book is in, if it's not on my nightstand, it's actually in the background of every video I've shot. It's a great book.
Oh, there you go. There's a little Where's Waldo moment.
Yeah.
So when you tune into Kyle Scholl's YouTube channel, look for the book Atomic Habits. I'll give you a little hint. The jacket is a light color. I would call it white. I'm sure my wife has a more technical term from the color wheel, but to me it looks like white or off-white or eggshell.
You're
but
funny.
it's a white cover. Look for it, and if you find it, shoot Kyle an email and say I found it. Found it. That's all you have to tell him in the subject matter. Found it. He'll know what you mean. What else? We're coming up to on the probably half-hour mark. You and I can sit here and do this day in, day
I can
out.
keep going. This is like I nerd out. I geek out at this stuff. This is good.
How about this? Let's go with three things.
Okay.
3 things that you wish everyone that you cared about and loved, and everyone that you will eventually care about and love if you just had a chance to meet them.
Sure.
You wish that they dominated when it came to their personal financial world.
Well, gosh, I don't want to be repetitive here.
Okay.
Because we've already said it. We've already said it.
Have we really?
We've already said it.
It's that simple.
Yeah. No. So the first thing that comes to my mind is personal responsibility, right? Not because we've mentioned working with a financial advisor a little bit, right? I was an advisor, Mike, great guy, but an advisor doesn't do it for you, right? They talk to you, they give you the path to go down, but you still have to do the grunt work, right? So taking personal responsibility over your finances, taking personal responsibility over your cash, your credit score, your credit report, your retirement accounts, personal responsibility. And then 2 is emotional intelligence. I hope that my family, my friends, my loved ones, anyone listening can have some emotional intelligence around knowing when it's the right time to make a purchase or knowing when it's the right time to just sit on the sidelines and save cash, or having the emotional intelligence to say, you know what, I'm going to take some risk here and I'm going to do X, Y, and Z with my money. That whether that's a real estate purchase, whether that's a stock market thing, whether that's increasing your retirement savings, doesn't matter. So personal responsibility, emotional intelligence, and then, because I am a finance guy, I want everybody to build wealth. I want everybody to have a little extra jingle in their pocket. And part of the reasons, I guess, either physically or psychologically, why I feel like that is because I've experienced being broke and poor, and it's not fun. And I've experienced doing very well, and
it's more fun.
It's more fun. It's more fun. So I want everyone to experience that. And for some, that's easier than others because not everyone starts at zero. Some people wake up like myself after college and have $42,000 of debt, right? I had around $20,000 of credit card debt and around $21,000 of student loan debt. Yeah.
Seriously?
Yeah. So when I was telling you earlier about how it was...
But you worked 3 jobs starting at 12.
In high school.
Okay.
Yeah.
Okay.
In high school.
Oh man, that's like a whole episode in itself. I love the before story. I love the before picture.
Okay. All right.
Yes, because it's human.
I'll go down that story
It's
if you tell me I answered your question, right? What was it? It was personal responsibility, it was emotional intelligence, and it was a desire to grow your wealth. To me, because again, not caring, right? I want people to have financial health and financial wealth because I feel like it's a better way to go through life. Instead of telling your son or your daughter, no, we can't afford it, you could say, it's not in the budget. Or you could say, we can do that. Or, yes, we can do that. Let's do it in 2 weeks and let's put it in the budget, right? But just having some ability of having a better quality of life, and money's a tool. Money's a tool to have a better quality of life. But I'm happy to go into that if you want to.
Yeah, JC, where are we at on time right now?
Yeah, we'll wrap it up. Part 2.
Part 2 coming up? Okay.
How to get out of $42,000 of debt.
Yes. You know what? If you have 20 minutes.
Sure.
Okay, we're going to wrap this show up.
Okay.
Okay, we're going to drop this episode, and then here's a little foreshadowing. We're going to have Kyle on another episode where we're going to talk about the before picture.
Yeah.
Because so many times people only see the after picture. But on this note, you're tuning into the Loan Officer Podcast. I'm Dustin Owen. He's Kyle Scholl. And Kyle, they can find you where?
Financial Awareness with K. Scholl. It's a YouTube channel about personal finance.
How about an email address?
Oh,
Twitter handle?
Gosh, I don't have my Twitter handle memorized.
But YouTube?
Everything's on YouTube.
Yeah, everything's on YouTube.
Yeah.
Perfect. Kyle, thank you for doing this show.
My pleasure.
And thank you in advance for sticking around because we're going to dive deep into the before picture.
Looking forward to it.
But ladies, gentlemen, children of all ages, preferably children 18 plus, that's all we have for you now. We're out.